Hello, I'm Jim Guffey, Executive Director for South Hills Interfaith Movement, SHIM as you commonly known us as. You know, 2020 is nearing the end, and this has certainly been an unforgettable year that none of us could have ever imagined. We have seen unprecedented need for food, need for clothing, need for financial assistance, need for education of our youth, all of that from the result of the pandemic. But at the same time as we have seen so much need, we have seen so many blessings from the community. The South Hills community is a community that supports neighbors helping neighbors, and we have been so blessed by the outpouring of that support. If you've supported us, thank you very much for all that you have done for SHIM. We could not do our work without you. If you're thinking of still supporting us, you can do that. Visit shimcares.org/give or give us a call, 412-854-9120, extension 109, or you can just send us a check. We greatly appreciate your support throughout the years and certainly in the challenging times that still lie ahead. You know, when you think about giving, there's lots of ways to give that I don't think people really think about. Fortunately, SHIM has a great friend, Mr. Chuck Stout, who has been a longtime supporter of SHIM, and he's here to offer some advice for you. And Chuck is tied to and working with DB Root and Company, and so we're thankful for their support to give you this informative video. If you have questions, there's lots of ways to help. We always suggest you talk to your financial advisor in making any financial decisions about your future and the blessings onto SHIM. You know, again, this year has been an unforgettable year, and we can't thank you enough. On behalf of South Hills Interfaith Movement, our board of directors, the 260 plus volunteers who have continued to support us with their sweat equity, for all of those people that we are serving, we thank you. We wish you a wonderful ending to 2020, and let's look forward to a much more prosperous and healthier 2021.
Hi, I'm Charles Stout. I'm a senior advisor with DBR & Co. We're a firm that's headquartered in Pittsburgh, Pennsylvania, also with a strong presence in Colorado. We are a wealth management firm that does a lot of asset management, but also a lot of financial planning for our individual clients. This time of year, a lot of our focus is on charitable planning and some of the tax strategies that our clients can use to make gifts in an intelligent way. So several weeks ago, we decided that we would put together this video to go over some of the key strategies that we use with a lot of our clients. These are pretty simple strategies, but at the same time, pretty powerful ones. And we thought the timing was really good because this is a challenging year for all of us, including nonprofits that we like to support. So in this video, we're going to be going through 4 major strategies, talking about why they can be very useful to taxpayers and also useful to the nonprofits that you're trying to support. So without further ado, we're going to get into this right away. So the topic of this video is charitable tax planning, and note the date, October 2020. This whole video could be obsolete by next year, but for now, these are strategies we are going to be recommending to our clients for this tax year. This is a disclaimer. Please feel free to read this at your leisure. It basically says we're the good guys and we're going to try to steer you in the proper direction. So this slide shows what has been projected to be potentially a fall off in charitable giving. This is part of the reason why we wanted to do this video, to show how you can have a win-win situation, saving yourself tax dollars and yet helping a nonprofit. And so we are trying to mitigate the impact of a difficult time for this country. Our stock market has returned very strong. And so hopefully these prior projections from earlier this year will not be accurate. But that's part of what drove us to want to do this video. The next page, we have our executive summary of our 4 strategies we're going to go over. first of all, is using appreciated stock, mutual fund shares, or ETF shares rather than cash to make gifts to charity whenever you can. The second one is how to use your required minimum distribution from IRAs. Thirdly, we're going to talk about timing your charitable contributions to get more of them fully deductible. And then lastly, what is a donor advised fund and why might you want to think about setting one up? Our first strategy is one of my favorites. Donating appreciated stock, mutual fund shares, ETF shares, or really any capital investment that you've made rather than cash whenever you can. Here's the strategy. You take a stock or mutual fund shares or ETFs, and then you get a tax deduction for their value on the date of transfer. The benefit of doing this is you don't pay any capital gains taxes on the gain that you had enjoyed. Now, you have to be very careful on this in that you can only give stock or mutual fund shares or ETF shares that you've owned for over 1 year. Some people say, well, should I use a stock that has gone down in value? Absolutely not. Those are shares you want to sell and use that loss as a capital loss to offset future gains. And also some of our clients will say, well, what if that stock you're suggesting I give to charity, what if I really like that stock? Well, it's really a double win because you can take the cash you would have given to the charity and go out and buy more of that stock or mutual fund or exchange traded fund. So there's no wash sale rule in this context. So you can continue to have that investment position and get out of the old shares without paying any capital gains. And no one pays a capital gain because you don't pay it because you didn't sell that investment. You gifted it to a charity. The charity doesn't pay any capital gains tax when they sell your donated stock because they're a tax-exempt organization. We put together a short example on the next slide. It'll show you, this is someone who bought XYZ stock some years ago, 100 shares for $10 a share. They invested $1,000. The stock is currently worth $50 a share or $5,000. If they were to sell that stock, they'd have to recognize a $4,000 capital gain. And depending upon their tax bracket, they could end up paying anywhere from $600 to $800 or maybe even a little bit more in capital gains taxes. And in some states, you also have to pay state income taxes on that gain. By making the gift of the stock and having the charity sell it, nobody has to pay any capital gains, and you can take the cash you would have given to the charity and give it instead to your wealth advisor or to the mutual fund company you're working with or to your stockbroker and have them rebuy into that position. It's a great way to use your winners. Just remember, you must have owned the stock for at least 1 year and 1 day. The next strategy we wanted to go over is required minimum distributions, or RMDs. I think many people know that once they reach a certain point in life, and if they have an IRA, they have to start taking at least a minimum amount from that IRA every year. The problem is that some people don't actually need that money, yet they're required to take it or face a stiff penalty from the IRS. The issue here is in the tax code, there's a provision that says you can take some of your required minimum distribution and give it directly to charity. You can't take it into your possession. You have to have the mutual fund company you're working with, or the broker you're working with, or the wealth advisor you're working with, send that directly to the charity. As long as you don't take it into your possession, though, you don't have to recognize it as income. So your RMDs are a great source of cash for making your charitable contributions. Now, it's gotten a little complicated recently. First of all, with life expectancy getting longer and longer, required minimum distributions don't start now until you're age 72, as long as you turn that age after January 1 of 2020. If you were 70 and a half before January 1 of 2020, you still are subject to the RMD rules. But further complicating it is because of COVID, the CARES Act has said for this calendar year, you do not have to take your RMD. But this is still going to be a very valid strategy for early next year. And you could argue that you could even use it this year as a source for finding money to give to the charities that you like to support, because you're effectively getting a full tax deduction on that RMD that you give to that charitable organization. So talk to your wealth advisor about this one. It may be still a good year to do it, and certainly it would appear early next year would be a great time to use your RMDs to give to charity. Strategy number 3, timing charitable contributions to make more of your donations deductible. This was really never much of a problem in the past for people that itemized their deductions. But today, with the standard deduction so high under the new tax law, it can be difficult to get over that amount. For instance, in 2020, if you're married and filing a joint return, your standard deduction is $24,800. $12,400 if you're single, and if you're over age 65, you add $1,300 to each of those. So if you're giving to charitable organizations year by year by year, most people are going to have a difficult time getting an extra tax deduction for that. One thing you can do is to bunch your deductions every couple years. So every other year, for instance, to give twice as much as you normally would. That may allow you to get above the standard deduction and therefore get more of a tax deduction for your charitable donations. And this is a perfect time of year to be looking at this as we go into the last part of 2020, but then also the very first part of 2021. You're really playing with 2 different tax years. And so you can sit down with your tax advisor, your wealth advisor, and pencil this out as to which strategy, which year might be actually best for you. Now, if you add up everything that you typically give for several years, and you're still not going to be above that standard deduction, then you do not want to itemize your deductions. That's clear. But if you're close, you may want to use this bunching every other year strategy. Now for our last strategy, strategy number 4, how to set up a donor advised fund and how to determine if it's something that you need or want. First of all, a donor advised fund is sort of like your own private charitable foundation. You set up a fund at a brokerage firm or a mutual fund company. Even some community foundations offer these. You can put your own name on it, Smith Family Fund, Smith Family Charitable Fund, whatever. Once the fund is established, you can transfer cash or stock or mutual funds or ETF shares or other types of investments that you've owned for over a year into your fund. The cash or the sale proceeds from the stock or mutual funds is then invested in a diversified portfolio and will continue to grow tax exempt into the future. You then can make grants from your fund to individual charities. As long as they're tax qualified charities, you'll be able to get a grant to them of cash. You are an advisor because when you set up the fund and transferred the assets, you had to give up legal title to get the tax deduction. You receive a federal income tax deduction the day you make that transfer to the donor advised fund of the cash or appreciated investments. So now you're an advisor to the fund, which sometimes worries people. Say, well, what do you mean I'm just an advisor? As long as you're recommending distributions or grants, as they're called, to a tax qualified charity, it will go to the organization you want to support. When does a donor advised fund make the most sense? When someone gets an increase in income significantly, it pushes them into a higher tax bracket. That can be one time. If you're doing the bunching up of charitable contribution strategy, we talked about in strategy number 3, you might want to use a donor advised fund as well. Or if you are wanting to give away appreciated stock, but don't want to be dividing it up between a bunch of different charities, you put it into the donor advised fund, it's sold, and then you can make grants out of the fund. The key to this strategy though, is to remember that while the money is in the donor advised fund, it's not doing anything for the nonprofits you want to support. Under current law, there's no requirement that you give away out of the fund a certain amount, a minimum amount every year. Personally, I think there ought to be some type of rule like that, but there isn't. Keep in mind, while the money is sitting there, it's not benefiting anybody. And so you do want to use this for making your grants. So in summary, we've gone over 4 strategies that really help many people in their charitable giving. Please take a look at these again and consider whether or not they will help you. There are plenty of resources available for determining which might be best for you. Your tax advisor or accountant, your wealth advisor, and the organization that sent you this video. So it has been our pleasure to put together this educational video. We hope you found it to be helpful, and we hope that some of these strategies will help you get into a win-win situation between your own tax planning and support of the many worthy organizations that are out there in our country. Thank you very much.